Good afternoon. My name is Dave Schmidtlein, and I'm Dean of MIT Sloan School of Management. Welcome as we commemorate Stewart Myers' 50 years on the MIT faculty. A special welcome, if we could, to Stu's family and friends and colleagues and former students who've been able to be here with us this afternoon. You know that we're going to celebrate Stu's extraordinary contributions to research and to teaching and pedagogy and also to practice. Stu joined the MIT faculty in 1966. He received tenure in 1974. And in the years since, in addition to his extraordinarily productive set of ideas, he's been an extraordinary mentor to many PhD students, dozens of them, in fact, and to many rising stars within the MIT faculty. In this, I'm told, Stu's last full-time year of teaching at MIT Sloan, but you know, that can be undone. You can keep changing your mind about that. Stu has actually innovated one more time, working with Professor Paul Asquith to create a new undergraduate course, a laboratory in corporate finance. It just, all of it makes us so very proud. Not to do a long description of my own personal experiences with Stu, which would take us too long, and I'm so grateful for. But we will all, and I have experienced his intellect and his expertise, his warmth and his humor, and if I can just call it out, Stu's uncommonly great storehouse of that rarity, common sense. And so with that, I would love to introduce the head of the finance group, Michael Korner, Professor of Finance of Entrepreneurship, Antoinette Shore, to introduce this afternoon's Fireside Chat moderators. Antoinette?
Thank you very much, and thank you very much. It's wonderful to be here with all of you and to see how many of Stu's collaborators, his friends, his students, former and current, are here to celebrate Stu and honor all his contributions. We are so delighted that you could all come and that we can have this event together. Because Stu has been really an inspiration for all of us from the day he joined MIT. I can't claim that I know the entire legacy, but I can tell you that since I've been here, I've not, to this day, never finished learning from Stu, being inspired by Stu, and really feeling, that Stu is a very unique intellect, somebody who has a very personal perspective on so many aspects of finance, which oversees, or which is more than just being incredibly smart, right? He's so original and so unique in everything that he does. But we will hear a lot of, about Stu's career and Stu's contributions through the Fireside Chat. Let me just give you one little anecdote. When I told Stu of Stu's, kind of brilliant sense of humor. When I told Stu that we wanted to have an event for him, he immediately said, "Oh, I'm sure this will be a roast." So I will leave it up to our distinguished panelists and guests to decide how much of a roast they want to do. But let me introduce, kind of the three panelists that will be talking to Stu this afternoon. All of them are long-term collaborators with Stu. First, to my left and to your left too, is Franklin Allen, who is the head of the Breven Howard Center and professor of finance at Imperial College. He has a long and very distinguished career also at the Wharton School. He has more prizes to his name than I want to kind of spend today, but he's also one of the co-authors of the famous Brealey-Myers franchise. So welcome, Franklin. The next person on the list is Dick Brealey, who is on your very right. Dick is obviously a long-term collaborator with Stu. He is a professor emeritus in finance at the London Business School. He's also the director of the Swiss Helvetia Fund and a deputy chairman at the Balancing and Settlement Code panel. I think there are I could go on and on, but I will leave it at this. Thank you, Dick, for being here. And then finally, but obviously last but not least, Larry Colby has been working with Stu for quite some time. Larry is a co-founder of the Brealey Group, from which he actually now is retired. He was a student here and worked with Stu a lot. And I will ask you to introduce all three panelists and, of course, our honored guest for this afternoon's Fireside Chat. Thank you.
Well, we've sort of semi-drawn lots as to who should go first, and I've won or lost, depending on your view. Before I came into this room, I had a brief chat with Stu, and I said that Antoinette had asked me to say a few words about our association together, and then to ask him these questions. And Stu said, "You can cut the first bit, and here are the questions that I would like to be asked." But I'm going to appeal to higher authority and say a little bit about how we came together. And it was in 1966, because I was working with a Boston mutual fund on the applications of portfolio theory, not very successfully. And while there, I started to come to the MIT finance seminars. And that fall, there arrived at MIT a very young, very fresh-faced giant who also obviously came to the seminars. And so today I'm celebrating not just 50 years of Stu being at MIT, but 50 years of friendship. So it's a very sort of great day for me. Some years later, after I had returned to London and to London Business School, I invited Stu to spend 6 months at the school. And McGraw had earlier asked me whether I would write a corporate finance text. And just before Stu went back to the States, I asked him whether he would join me as a co-author. And I still have a copy of his letter which says that he was very sorry, but he was far too busy. But obviously, somehow or other, I persuaded him to change his mind, and I'm terribly grateful that I did. We had some very good times writing the book, and I sort of have happy memories of sitting in our garden at home in Cookham in England, and up in Stu's log cabin in Maine, and sort of arguing about what should go into each chapter. And I'm not sure Stu has such good memories, because our cottage has ceilings of about 5 foot high. And so he either had to crawl or well, you can see, if you look carefully, the bump on the top of his from the beams. Anyway, the usual routine at our meetings was that I would make a dozen or so stupid suggestions, and Stu would very gently explain, say, "This is what we're going to do," and that would be the end of it. We decided early on that we weren't going to be pompous, we were going to have a casual writing style and try and make it as much fun as this dull-sounding subject can be. And then Stu added the jokes afterwards, and I'm sure you probably heard this story, but one reviewer said at the time that these English jokes would never go down with an American audience, and of course they were all Stu's. So for me this afternoon is a great opportunity, not just to acknowledge Stu's period here, but also to thank him for his collaboration and, as I say, for 50 years of being a great friend. When we met in the 1960s, that was what I think of as the golden age of finance. Markowitz had not long before published his book on portfolio theory. Bill Sharp, John Lintner, Jack Traynor had recently published on the CAPM. M&M had published on their relevance theorems. And it was Gene Farmer and his colleagues at Chicago were producing an enormous amount of stuff on the efficient market hypothesis, which seemed to support very beautifully that hypothesis. And Black-Scholes and Merton were just about to produce their option valuation model. So it was a period of enormous excitement in which people were just sort of bandying around ideas all the time, and enormous innovation. And I many of those ideas, or I think all those ideas, still form the basis, amazingly, of what we still teach in the classroom 50 years later. But since then, the rate of innovation has slowed dramatically. And so my first and awkward question for Stu is, why did we get this burst of innovation? Why did it slow? And what is that going to change? Are we going to have are we coming to new sunny uplands? Was it just, as Larry Summers would say, that it was catch-up economics, he would say merely catch-up economics, and that they were fully exploited by the end of the 60s or the early 70s?
Well, okay. We should catalog, let me tick through the ideas you mentioned. Dig and Miller, capital asset pricing model, efficient markets, Black-Scholes, option pricing, what have I missed?
Portfolio theory.
And portfolio theory. I was lucky to start in mid-60s, and I think that what broke the dam and unleashed all of this was M&M. Not necessarily because they thought that capital structures are relevant to value, which of course is the theorem, but because they had set it up in a way that emphasized that the natural goal of the firm is to maximize value, and we got to understand what's happening in financial markets first before we started to draw conclusions about corporate finance. And that, at the time, was an enormous innovation. I could point you back to articles written at the time which treated the capital markets as sort of irrelevant and focused entirely on what the managers wanted, or more formally on their utility function. And as soon as you got the idea, I did as a graduate student, that it all hinged on understanding what is happening in financial markets, all of a sudden, things clarified, and the stage opened up for ideas that then seemed to follow naturally, like the efficient market hypothesis, or other developments of the MM's theorems about payout, et cetera, et cetera. Now, if you think of those big ideas in total, they covered most of the space of corporate finance. And it isn't as if there was space left there to be filled. By about 1975 or so, all of the space of problems that we think about in corporate finance had been covered, not solved, but at least covered by these ideas. But then if you go up to today, 50 years later, it is odd that I think none of these ideas have been replaced. They have been developed, they've been qualified, but they haven't been replaced. And the only one I can think of that should be replaced, if we could just figure out how to do it, is the capital asset pricing model. The capital asset pricing model is used everywhere to estimate the cost of capital, even though we all know it's wrong. Or if it isn't wrong, it's right for reasons that nobody can figure out. And yet it's used everywhere in business because there's no tractable alternative. And the asset pricing theory is getting more and more complicated. Maybe better, but if it gets more and more complicated, it's not something that you can put on a CFO's desk or write down in a textbook in any reasonable way. So you want to ask me about efficient markets now?
No, hang on just to your last point. Okay. In the first edition of our book, there was a sentence which you wrote, which said, in 10 or 20 years' time, we will have much better theories of risk and return. In the last edition of the book, you still wrote that sentence, but you said, we may have better theories. What's the answer?
I don't know what to do about the capital asset pricing model. I'd like something better, but I don't know where to find it. And if you asked me to point out the weakest part of our standard textbook corporate finance, it's that, the capital asset pricing model, but we don't know what to do otherwise. It's true in rate of return regulation that you can also get estimates of the cost of capital from so-called DCF models. And maybe you can use those DCF models for nice, sleepy companies. But otherwise, the CAPM seems to be all we have. It's very unfortunate. I wish I had a great answer for that.
One of the problems, it seems to me, in teaching these days is how we teach many of these basic ideas, because they're not... 40, 50 years ago, it was very simple. We taught capital structures development. Well, it didn't satisfy students very much, but you know, it was nice and simple and straightforward. Capital markets are efficient, etc. And since then, of course, we've come to qualify many, not to abandon those ideas, but to qualify them. And in many ways, I think that makes it more difficult. And let's take efficient markets, where we've clearly discovered a large number of anomalies, which are anomalies really about the weak and semi-strong forms. And those anomalies are huge, apparently huge. They are uncorrelated, mainly. And they seem to suggest that there should be enormous opportunities for making superior performance. And yet, the strong form of the hypothesis seems to hold much more strongly than the weaker forms. In other words, that do not seem to be managers that have consistently superior performance. Why is that? Is that because the anomalies are transient and you can't exploit them, or you fear they will be transient? Or is it that we have so much noise in our measures of performance that we don't really know whether there are any good managers out there? It's just difficult to identify who they are. Now, I know you want to talk about noise. You said you wanted me to ask you a question about noise.
So I don't have a good answer to that either. Some of these anomalies of the weak and semi-strong form are certainly going to be transient, because I can't believe the hedge funds don't jump on them. The more fundamental ones, like the so-called value effect, seem to persist. Value effect, just in case you've forgotten, is the idea that value stocks do better than they should, according to the capital asset pricing model. And that seems to be built in more fundamentally to asset prices. It could be that the value effect is masquerading or standing in for some macroeconomic risk factor that should be priced, and therefore it's not wrong if the value stocks do on average better. But I think I would dodge, from the point of view of corporate finance, I think I would dodge the question as follows. When you're making corporate finance decisions, which basically involve valuing things, either assets or securities, I think it's wise always to start out and value things on fundamentals as if the world were efficient and rational outside. Right? Now that may not be the final truth, but if you don't start there, you're going to screw everything up, because you're going to mix up your opinions about what's wrong with the market with your opinions about fundamentals, and you won't be able to untangle them. So almost always in corporate finance, you start out with the fundamentals, and then if you get to an opinion about value based on fundamentals, then you can ask whether there's some mispricing out there or some kind of inefficiency that would lead you not to act on the fundamentals. And it's surprising how often, when you ask that latter question, the answer is no. Stick with the fundamentals. And if I can just give the classic example, if you listen to investment bankers make M&A pitches, they're all about valuation and always assume that if you just figure out your multiples and your comparables and all that sort of stuff, you will have a better idea what the target company is worth than the market does. Right? So, but wait a minute, let's pose a question. Let's suppose that you were a potential acquirer and you were convinced that your target was grossly undervalued by the market. Is that a good reason for a merger? No. Because if you want to profit from that knowledge, you just go out and buy the stock. Why pay an investment banker? And the lesson would come back that you don't merge unless the fundamentals are right. right? So I realize that's a dodge in the question of efficient markets, but I think that's important in corporate finance. If you don't get the fundamentals right, you're going to just confuse yourself by bringing in your opinions about these anomalies and how they might apply.
What about the problem of noise, particularly measuring performance? I remember many years ago doing some simulations of markets portfolios and then trying to estimate how long it would take before you could measure with a reasonable level of statistical significance whether a manager was better than average, and the answer was, under idealized conditions, about 25 years. So there's an enormous amount of noise when we try and measure performance.
Right, right.
Does the problem of noise?
Yes. Yeah, the answer is yes. It's a big problem in measuring performance, but it also tells you how hard it is to exploit some of these anomalies, because if you're running a mutual fund, let's say, or any kind of portfolio, and you start out to exploit, what's your favorite anomaly besides value? Earnings announcement drift or something like that. If you start out working hard to exploit that, it may be 20 years before you're proved right. And by that time, you'd like to be on your yacht and sitting somewhere off the coast of Florida. So this kind of, if the anomalies offer this kind of long delayed gratification, I can understand why people don't pursue them. Now, can I say a word about noise? You've been allowing that. So I would recommend going back and reading Fisher Black's presidential address to the AFA years ago. And the title is simply Noise. And the argument is very simple, that once you get involved in financial markets and you realize the noise that surrounds you every day, you get somewhat more sympathetic to people in real life who maybe don't pursue the anomalies, or maybe are a little bit less confident than a statistician would be that they understand what's going on. Okay?
Yeah. Can I think I've asked enough questions for the time being and talked enough. Franklin, I know you've got some really awkward questions.
So first of all, I'd like to thank Antoinette for inviting me to be part of this wonderful event. Just before the holidays last year, I received an email from Stu, and attached was a PDF of an article that was coming out in the annual review of financial economics that Bob Merton and Andy Lowe edit. And it was Stu's intellectual autobiography. It's a wonderful article. I recommend it to you, all of you, both for the personal reminiscences that Stu has, but also for the intellectual content. Now, he starts out by describing that he got into finance because it was boring. And he recounts how he was doing an MBA at Stanford, and they were just doing Harvard case after Harvard case, and there was no intellectual continuity at all. So he started skipping class. And Alex Robachek, who was the professor, realized he wasn't coming to class, and he called him in and said, "Why aren't you coming to class?" And Stu said, "Well, it's boring." So they started talking, and Alex Robachek discovered that Stu was doing a PhD course in macroeconomics at the time. And so he realized he was intellectually curious, so he put together a whole stack of corporate finance research papers and gave them to Stu and said, "Come back next week." And Stu read them and realized that finance was really interesting. And he finished his MBA and then went on to do a PhD there. And there was the start of a several-year collaboration with Alex Robachek, which was a wonderful time, and he describes all the ideas that they worked on together. Now, let me just say a little bit about how I became acquainted with Stu. I did my doctorate at Oxford, and at that time the hot topics at Oxford were public finance and development economics. Now, finance, corporate finance, was not really done at all there. In fact, in the UK, it was only Dick Brealey and the group at London Business School that did finance. Now, my advisor then was Joe Stiglitz, and so he was doing finance, but I remember him complaining bitterly that they didn't even have the Journal of Financial Economics in the library. So I ended up writing a thesis on share contracts, but it was really more about development economics, but I managed to get a job at Wharton because it was like an equity contract. So then they asked me to teach the introductory corporate finance course. Of course, I didn't tell them I knew nothing about finance. So we started out, and we had this textbook by Weston and Brigham, which was one of the leading textbooks at the time. And I didn't find finance boring. I found it terrifying because I had no idea what was going on. You'd read a chapter, and it was well written and things, but there was no intellectual continuity between the chapters. There was no framework for thinking about things. So when the students asked questions, I simply couldn't answer them. If they said, well, how does this relate? I couldn't do it. So fortunately, I was very lucky because somebody who had my office that I was in over the summer had left a copy of Brealey-Myers in the office. And so I suddenly started reading. I thought I'd better do something about this. I started reading it.
You'd probably thrown it away.
Well, it was the best thing that happened to me because suddenly it all made sense. It all fitted together. And I learned finance from the book. And so I became very interested in it, and it became fascinating to me. And one of the things I was particularly interested in at the start was capital structure. And so I read all of Stu's papers on capital structure, and they were really a revelation of all the different ways that you could think about things and the interesting ideas they contained. And remember, I didn't actually meet him in person until quite a few years later. And it was at the AFA meetings. And I remember I was kind of looked up at him in every single meaning of that word. It was just such a presence in every way. So when I had the opportunity to join the team of Brealey-Myers on the textbook, I said yes straight away. And it's been the most wonderful intellectual experience. And I think you can see some of the reason for that when Dick and Stu are talking about finance. It's just the set of ideas and the way they toss them around. It's just been a wonderful experience all round. Now, I had gone through and prepared a whole set of questions. Dick came at the beginning and said, you can't ask this. Dick's got your questions for him. So the first one, which is a very good question, is were M&M right or wrong about capital structure, or were they just providing a way of us thinking about it?
I've decided they were right. Period. And thank you for giving me that softball because it is something that something I'd like to comment. I really would like to comment on. So Medignan and Miller, for those of you who remember, had this famous theorem in 1958, which nobody believed at the time, saying that the capital structure of a company was irrelevant to the value of the company. And their logic was impeccable, and in fact, their theorem can be proved umpteen different ways. It's much more general than you would think just by reading the, by today's standards, somewhat clumsy and artificial way they talked about homemade leverage. And then what happened is that people, including me and Alex Robichek and others, started thinking about exceptions or things that would qualify the statement that leverage is irrelevant to value. Okay? And that led to the so-called trade-off theory, which Alex and I actually introduced way back in '65. My later work in information and the so-called pecking order theory, and now we have timing theories and I forget what else. The key idea, which I didn't come back to until recently, is that Medina and Miller made a statement about valuation of the firm. They did not make any statements about what companies actually would do. And in fact, the propositions leave lots of room for different kinds of tactics, different kinds of financing tactics, different kinds of financing behavior, different debt ratios. There's nothing in that would raise a red flag if one company operates with a cash mountain and another company operates with a lot of debt, or if one company wants to use convertibles and another company wants to use junk bonds. One company wants to issue equity worldwide, another wants to issue equity privately. Leaves room for all of that, because if the value of the firm does not depend upon capital structure, up to, let's say, an error band of a couple %, then the couple percent, there's plenty of room for all the variety of financing that we see in real life. So why not invoke Occam's razor and come back to the simplest explanation, which is were right up to an error band of, let's say, plus or minus 3%. And all of the financing behavior we observe out there is just tactics, which don't have a large effect on value, but nevertheless are worth doing if it gives firms a little bit of an advantage here or there. What's wrong with that interpretation of the evidence? If you look hard at the research that's gone on in the last, 20 years or so, particularly empirical research, I think that research is researching or trying to understand tactics. And that's good news or bad news. The one is, it's important to understand tactics. It's interesting. The bad news is that investigating tactics is not going to lead you to any grand theory. And not only that, I come back 20 years ago, 20 years from now, the tactics will have changed, because they'll change in response to changing markets, changing economies, different worries on the part of CEOs and investors about what risks are most important or less important. So we may be in a situation now where tactics are important, tactics are interesting, but I don't see any evidence that Medina and Miller were wrong in the first place. Now, having said that, I'm in a way undercutting some of my own work, because of course you have this trade-off theory which says that everybody comes back to moderate debt ratios. I'm an originator of that theory, but I've been skeptical about it for a long time, partly because people seem to try to improve it by making it more complicated. And in the article that you referred to, my analogy now is it's like the trade-off theory is like a coat rack, and anybody comes in with a new idea and a new coat, puts a new coat in the rack, and they don't care whether the coats clash or not. And eventually the coat rack gets so full that you don't know what's going on. And then the pecking order, which I also came up with, is, I think, a darn good idea when you get to equity issues and how big corporations behave, but I never said it was the whole story. So, to summarize, I'm willing to, if we had a debate today, I'd be happy to take the side of the proposition that were right, period. Is that okay?
That's okay. So it's interesting because I think that there was a stage, if you look at your paper with Shyam Sundar, the empirical one, where you regarded them as competing theories, the trade-off theory that you developed early on, and the pecking order theory that you developed subsequently. And I guess that the way I've always thought about it is that they're referring to different scenarios. So the trade-off theory is a long-term theory, and then the pecking order is a short-term theory when there's asymmetric information. The long-term, in the long term, that'll probably go away or come back in different forms. And one of the
I don't understand what you mean, but why did you say it was a short-term theory?
So because the asymmetric information that underlies it, that they have better information, at some point will probably come out.
But you see, I'm not sure I agree with that, because it's always the case that managers know more about their companies than outside investors do. Now, whatever managers know at the moment will be revealed with some lag to the market, but by the time it's revealed, there'll be new information coming in to the managers' heads. So it seems to me the simplest hypothesis is if there is difference in information, probably constant over time, because it keeps getting refreshed.
So you wouldn't say it would cycle, so there were some times when it was more and sometimes when it was less.
Okay, fair enough.
And then the trade-off theory would matter more, the taxes and so on.
I'm not sure I'd say this. I don't think I'd put it that way.
So you would still think of it, I mean, it sounds like the trade-off theory you don't believe very much. It's more were right, so it doesn't matter. But you still believe the pecking order to some extent.
Well, I think the pecking order works for particular classes of companies and not for all. So for those of you who don't know, the pecking order basically says that if managers know more than outside investors, and outside investors know that, then debt is going to drive out equity. It's a very simple idea, which is that if you're going to buy something from the company and you know the company knows more than you do, you'd like to buy the security that's least exposed to your ignorance. And so that says that companies will use debt rather than equity, and equity is a last resort. For big public companies, I think that's broadly true. But that theory can be disproved any time you see a company issuing stock. So it obviously doesn't apply generally. And this, can I go into one of my pet peeves here? So the trade-off theory has been tested by probably, I'm guessing, at least 6 or 8 good published papers. And the typical conclusion is that the trade-off theory doesn't work and must be wrong for the following reason. Somebody says that, okay, at the trade-off, I'm saying trade-off, I meant pecking order. The pecking order assumes that the problem comes from information asymmetry. Information asymmetry must be worse for growth companies, small companies, high volatility companies. And therefore, if it doesn't work for those types of companies, it must be wrong. If you actually look at the Myers-Marklouf paper, it says specifically that it will apply best to companies that are mature and have substantial assets in place, because the problem with the information asymmetry is not with investments for growth, but the possibility that assets in place will be valued wrong. And in most of these tests, the pecking order works better on mature companies than on growth companies, which is exactly what the theory predicts. Yet you see articles say that the pecking order theory fails because it doesn't work on growth companies. They are absolutely turning the theoretical prediction around, and they're going out to test something that the theory never predicted. And at the same time, typically commenting that it works pretty well for mature companies, but, right? Pet peeve of mine. And by the way, in more recent research, I think there's other reasons why you can get pecking order behavior, including some of the agency reasons that Bart Leverick and I have been working on, but that's another topic.
So,
Anyway, to go back to your first point, I never thought of the pecking order as a short-term thing, and the trade-off theory as a long-term thing.
do you regard them as being potentially consistent with each other, though? Both could be at work, at play.
Yeah, but I resist that, because that's like just putting another coat on the rack, you know. So I think even though one has to agree that all of these factors, all of these forces or factors that affect capital structure. They can all be operating at once. But if you end up with a theory of capital structure that has 10 variables and can be twisted around to interpret almost any event, then I don't think you got anything. And so I think it's intellectually useful to run a horse race between simple versions of the theories, not because you think the simple theories are the final answer, but because the horse race teaches you something.
If we go back to your first answer about where M&M right, what's your view now on taxes? I mean, we've spent so much time in corporate finance thinking through the effect of the corporate tax code and the personal tax code and so on. How do you now think about that, given what you said at the beginning?
I'm puzzled, I must say, because you found the chink in my armor when I started talking about MM being right, because any kind of analysis of the U.S. corporate tax code says that taxes favor debt, and that the tax advantage to debt ought to be big. Well, if that's the case, why aren't firms levering up much more than they are? Yet, I say that MM were basically right and everything else is tactics. The implication would be that whatever the effect of taxes, it operates at a tactical level and not a fundamental level. And frankly, I don't know why that's true. Bart Lambrecht and I do have a paper in which we analyze or model management's behavior with respect to capital structure. And you can there get equilibria where taxes contribute to market value but are not pursued by managers. So that may be a partial answer of why the taxes don't affect it. Why taxes are operating at this tactical level that I think of as fundamental value plus or minus a couple %. And the queer thing about taxes is the amount of ingenuity and sophistication that companies use to save taxes when they're doing specific transactions. So you can't say that companies ignore taxes, otherwise we wouldn't have leveraged leases, for example. We know they don't ignore taxes, but somehow when you get to the big question of how much debt and how much equity, the taxes don't seem to be driving things. And I don't have a very good explanation for that, I must admit, unless you go to these agency bonds.
The other interesting things, if you look across countries, I mean, we tend to get into the specifics of the US tax code, right? When I was teaching in Japan, we did the asset pricing and that was all fine because that was kind of institutional and less. But then we started getting into corporate finance and I'm talking to all these Japanese people about the US tax code and it didn't seem quite right to be doing that. And that's why I find the first position of the tactical answer as a very interesting one. But on that note, let me turn it over to Larry.
All right. Well, I met Stu in 1978 when I was with Charles River Associates, and we had a new project involving rate of return regulation on oil pipelines. And the miracle for me in that project was that I learned for the first time that there was a theory of the discount rate. I was at MIT in the econ department on the third floor of E52 in the late 60s and early 70s. And at one point, someone taking notes less rapidly than I was asked Robert Solow, how do you get the discount rate? And my firm memory is that he replied, oh, there's no theory of the discount rate. Nobody knows how to get a discount rate. You can ask the policymaker, the world grows at 3% a year, you can do that. Upstairs, Stewart Myers is teaching the capital asset pricing model. And I know Franco Modigliani traveled between floors, but no one else seemed to. Or if they did, they didn't talk very much on the third floor about what they learned on the fourth. And I know that it's not only I who had this problem, because as soon as I learned there was a theory of the discount rate, I called up everyone I knew who was of a contemporary era in graduate school of mine in the econ area. And they were all stunned as well. It had been something that had been driving me crazy, my whole study of economics. Everyone would say, then you discount it, but no one could tell me how to get the rate. So that's when I decided that financial economics was something I really wanted to pursue, and I ended up making a career out of it, not by reading the textbook, but by asking questions of the man next to me. And his students, like Jamie Reed, sitting in the audience, who had formal training. And I just kept trying to read ahead of the course. In the prospect, a lot of what I did ended up involved with rate of return regulation. And it's probably not widely enough known that Stu is actually a real pioneer in that area. He was the first person, I believe, to ever use what's known as the DCF model to estimate the cost of capital in a rate case. His 1972 Bell Journal paper is the first place where someone sat down and said the rate of return that it should be used for the concept of a just and reasonable rate on the investment in the public utility should equal the opportunity cost of capital as taught in modern finance. Before that, there were all kinds of mechanisms for that. You know, you should match accounting rates of return. There were all kinds of standards. He was the first one to do that. So I'd like to start my questions asking Stu about some of the things he's done in the area of rate of return regulation. And I'll start with the Comcast case, which is actually ComSat case, because it comes back with a variation a number of other times where there's, but this is the first variation on a theme of risk and return for regulated entities. And I would ask you to describe the ComSat case and what's generally interesting about it.
So yeah, I actually started doing rate of return stuff for a regulated gas pipeline, and I'm amazed to say this, but I was the chief rate of return witness in the 1971 AT&T interstate telephone rate case, which was by far the biggest rate case of the year. You remember that AT&T used to have an interstate long-distance monopoly, and it was regulated, and you had to figure out what the rate of return ought to be, and 1/10 of a percentage point up, and 1/10 was big, big money. So I was amazed that they asked me to do that at 31 years old. Amazing. But anyway, I got through that, and that was, by current standards, kind of a straightforward estimate of the cost of capital using DCF, checking it against the CAPM, all that sort of stuff. And then I was asked to get into ComSat. You remember ComSat? That was the company set up to put satellites in the air for telecommunications satellites put up in the air. When it was first went into its IPO at 62 or something, 1962, 1963, it was a hot stock, and all grandparents wanted to get 100 shares for their kids and so on. But it was a high-risk enterprise because nobody knew for sure that they'd be able to get those satellites up and whether they would work or not. So, but after they were up and working and everything was now routine, they came for their rate case before the Federal Communications Commission, which said, oh, this looks like another long-distance company. So I came in and pointed out that the company's beta had been well above 1 for its entire life, so it can't have been a typical utility. And I actually failed to convince the FCC that it deserved compensation for the risks that its shareholders bore. I failed. Not because I think I explained it pretty well, but it just didn't get through. Now, with hindsight, you can sort of see what happened. It's very easy for regulators, when something succeeds, to forget about the risks that had been run. And there's no particular incentive to compensate investors of the company for the risks that are run successfully. And so they didn't get compensation for those risks. It's just, so anyway, it was a wonderful exercise to try to explain the capital asset pricing model, I think for about the first time to regulators. And I was even the hero of a Harvard case study at the time. One of these things that says Stewart Myers, cases always start out and say, Joe Blow was at his desk worrying about this and that. And here's this problem. And it started out, Stewart Myers was sitting at his desk. But you know, if you go back to what it is now, where we can see this now, I can see a different interpretation of it. Because if you have a company that starts out in life with a heavy capital investment program ahead of it, the capital investment program operates like debt. It creates the same kinds of risks that debt does. Anytime you have a more or less fixed obligation to pay money ahead of you, more or less fixed, the risk of the residual position is high for the same reason that your stock portfolio is very risky if you trade at a margin. And then what happens is that as the company succeeds and gradually the big capital investments get behind it, the risk comes down. So this is something I got into with the pharmaceutical R&D later. But it's exactly what you would expect. Early on, the beta is high because there's hidden leverage. And maybe if I figured that out at the time, I could have explained it better. I'm not sure.
Going back to your question, or your answer to the question on leverage and taxes, is what you just said an indication that we're measuring leverage wrongly?
Oh, yeah.
Yeah.
So Jamie Reed, I have a paper which I'd love everybody to read, which hinges on the hidden leverage in real call options. So if you get a growth company which has growth opportunities, you can think of those as call options. You know that call options are equivalent to leverage positions on the underlying stock. That means a company with lots of growth options has hidden leverage. And we would argue that that hidden leverage in practice displaces explicit leverage, which can take you quite a ways in explaining why growth companies seem to operate at low debt ratios. And the answer is they don't, but you only see part of the debt. So I hope people read that paper. We like it. We like it. So is that an answer? Did I go off on a tangent?
No, you went straight there. That, in other words, the issue of leverage is not that necessarily that companies are wasting opportunities to save taxes. It might be that they're actually leveraging in different ways.
Yeah, see, the trouble is that the leverage that's hidden in, let's say, a call option, a growth call option, is not tax. The interest on that is implicit and it's not tax deductible. But it still is leverage. So it would make sense for companies to back off.
You value that using the net interest rate.
Yes.
Come back.
Yeah, we'll come back to that. So, I'm sorry, have I gone
No,
off the
no,
track
that was
there?
great.
I'm sorry.
I would ask you to also to talk about the oil pipeline case where we met, which just as a bit of background, in 1977, Congress started the Federal Energy Regulatory Commission to replace the Federal Power Commission. And as part of the effort, this is in furtherance of deregulating natural gas prices one way or another, which had been regulated by the Phillips decision in the 50s, the Supreme Court decision. And in the process, they took oil pipelines, which had been regulated as common carriers by the Interstate Commerce Commission, and put them under the FERC. And the FERC had been regulating gas pipelines on what was then and remains the most traditional U.S. method, not traditional in the rest of the world, which is on original net book value, as written in the accounting statements with some modifications for regulatory assets. And so everybody suspected that what the FERC was going to do was to start the oil pipeline industry at its net book value. The Interstate Commerce Commission had done something else. They had used what was known as a fair value rate base, which in the 1930s meant any old thing anybody wanted, and often meant the market value of assets as implemented. And of course, that was utterly without intellectual support at the time. And so the Marathon Oil Company didn't like the way the industry was defending the Interstate Commerce Commission rate base, and so they hired Stu to come in and see if there was anything they could do to get something other than a switch from the Interstate Commerce Commission rate base to original cost, which led to some, very interesting issues. There's uncompensated switch, there's TOC, et cetera. If you could just discourse on that
Okay,
case.
so that was, well, first of all, when you think about it, if the companies had been operating on a so-called fair value rate base, but it is calculated by formula,
Yeah,
and it to some extent incorporated inflation, which for many of these oil pipelines it was a big effect because they might be 30 or 40 years old.
does
So
everyone know what the rate base is?
rate base, the way it works is for a regulated utility, they have a rate base. So for something like a traditional, I don't know, local gas distribution company, it's typically just very close to the net book value of the assets that are shown on the company's books. And then you allow a rate of return on that, which is supposed to give a fair rate of return on capital. That's the idea. There's all sorts of problems with that, but the one that we can focus on here is what happens when you have an industry which has been operating on a different rate base, which has incorporated inflation to some extent, and now you want to switch it to, or propose to switch it to the historical cost. Well, the effect of that is that if you do the switch, you immediately wipe out the difference in value between the old rate base and the new one. And once you realize that, the obvious answer is you start the new rate base at the old one. Even if you want to do traditional rate of return regulation, you got to start. You got to start where you left off in terms of the rate base. But then the other fascinating issue was inflation. So here you were in the late 70s, early 80s. Inflation was running at double digits. And you have assets, oil pipelines, that might last for 30 or 40 years. And you could be in a situation where you had a pipeline that was built, let's say, 20 years previously, and a new pipeline going more or less parallel and serving the same market. You would think that those two pipelines would be allowed to charge the same price. But under rate of return regulation, the old pipeline, whose assets have been depreciated way down, would be forced to charge a low price, and the new pipeline would be forced to charge a high price. Does that make sense? Larry's favorite theorem is that I guess came from me.
Yeah.
You want to repeat it?
The tomatoes theorem. The price of tomatoes does not depend on the age of the tractor.
So,
That's Stu's.
so you can see the practical problem. It's not just that old and new pipelines are being priced differently for no good reason. The next problem is that if you build a new asset, if you put in a new asset at a time of high inflation, the effect, and regulate it by allowing a nominal rate of return, you get the same kind of front-end load in real capital charges that you get on a mortgage. Some people are old enough to remember taking out mortgages when we had double-digit inflation and painfully paying every month a 10 or 15% interest rate, but knowing that because of inflation, the real burden of that mortgage is going to come down really fast. So that's what's called a front-end load caused by inflation. Now, if you're going to build a new pipeline, you don't want to build in that front-end load because it distorts pricing. What's the answer? You just do it on a price level adjusted rate base, a real rate of return on price level adjusted rate base. And so Larry and I worked a long time taking that simple idea and trying to put it in a form where the regulators would believe it worked and show them how it worked specifically and so on. So we were only partially successful in that case. It was weird because the FERC put out a crazy, perhaps I shouldn't say that. Yeah, I'll say that. A crazy decision, just a nutty decision, saying we're going to just do it the way we like, and then that was knocked down by an appeals court, and then finally the FRC came back and say, we'll accept trend and original cost, as Professor Myers proposed it. The problem is that they couldn't get up the courage to just do it, so they decided we'll do the trended original cost, but only in the equity part of the rate base. And regulators in the US, maybe elsewhere, have this really queer conviction that it's necessary to regulate the cost of debt and the cost of equity separately. It's the overall cost that matters. And if they could just get up the courage to set the overall cost of capital properly, then they could get out of the business of watching whether the company had a 48% debt ratio or 46% debt ratio and so on. But we did make some progress with that, and I think elsewhere in the world, that kind of regulatory structure, inflation-adjusted rate base, is widely used now.
Do we want me to keep going? Do we want to cycle back?
You're doing fine.
Okay. Okay. Well, the next big issue that is to a degree related to the ComSat case that we worked on in rate regulation had to do with asymmetry of risk and return. And in particular, a case in which regulation would set us up to where if things go as planned, you earn your cost of capital, which is essentially on your investment, which is essentially breaking even. And if things go really wrong, you lose a ton of money. So it's sort of heads you lose, tails you break even. And then they'd say, but you got your cost of capital, right? So it must have somehow compensation for that risk must have been in there, like regular spaghetti sauce, for those of you old enough to remember those commercials. And so there were a whole slew of things that Stu and I and others at Brattle did involving gas pipelines and electric utilities at the time of deregulation and so forth that elaborated this issue and talked about what to do with it. So I'd ask you to discuss on that.
Actually, Larry, I think you've covered the main point already, that rate of return regulation works fine for safe assets and boring utilities. It works fine because there's not much downside normally, and there's enough monopoly pricing power so that you can get the rate of the cost, can earn the cost of capital more or less, or on average. But it breaks down anytime you have risky assets. The extreme example of that would be, let's say, the gas pipelines, which were locked into contracts that were ruinous in, Paul, when am I thinking of this? Early 80s. Early 80s. It's absolutely ruinous. There was no way these companies could survive on the contracts that they were locked into. The problem really is that they're locked into a contract at the one end where the gas prices were very high at the other end.
You remember you were on my committee when I was writing about that at the time.
Right. But the regulators didn't do anything, right? And they should have figured out some way to, if not to rescue these companies, at least to compensate them to some extent for the losses they incurred because of contracts and regulations that the regulators had set up in the first place. The same thing happened with nuclear power plants a little bit later, when people discovered the nuclear power plants were very, very expensive. After 3 Mile Island, a lot of them were canceled. There were enormous losses of money that had been spent, and the regulators wouldn't allow them to recoup. And it's a perfect example of a situation where you have a so-called fair rate of return, and the regulators have a call on the upside, but they don't provide a put on the downside. And that's okay if the variance is very small, but when something hits, you get disastrous losses. And this kind of regulation is just not equipped to handle risk unless you had very, very, how do I say this? Sometimes I think, I've seen situations where there have been losses, and although the regulators didn't compensate them directly, they sort of sweetened the pie in other ways, sweetened the pot in other ways so that the company could climb back out. But you can't count on regulators to do that, nor to give you complete compensation in that kind of ex post way. So I just think it's built in to this kind of this kind of regulatory system, and I suppose the bottom line is you don't try to regulate risky assets in that fashion.
Well, the safe assets sometimes become risky assets ex post is the problem.
Yes, true.
So, which is the way in which it's like, the reverse happened with ComSat, but it's the same general problem.
Right, exactly.
Would you care to, as long as we're on this topic, care to comment on your work with Jerry Hausman on real revenue adequacy, which is a related topic?
Yeah, and that's a kind of real options application. It starts with the same problem, that if a railroad puts in a bridge or a track, it's not going to move it. And if regulation means that you can never earn more than the cost of capital of that bridge or track, but then you can't earn less, you're not going to invest. So Dick Brealey is smiling because he led a blue chip panel to figure out what to do with this kind of revenue adequacy idea for railroads. Pardon me?
Forget the idea.
And that's right, you should forget the revenue adequacy idea. But it's an interesting real options problem of how you would decide how good the revenues from an irreversible investment have to be in order to justify the investment. So if you have a real call, you never exercise it at the money. You've got to wait until it's far enough in the money that you're compensated for the downside. The interesting thing about railroads, though, is that if you really think about that, it's not the case, or it shouldn't be the case. I'll get back in a second. Suppose that you were trying to approximate a competitive outcome by way of regulation. And you think of somebody who's building or going to put in an irreversible investment in a situation where competition might come along later and take away your business. Now, technically speaking, this is something called contestable markets, but I'm not really going all the way there. I'm just asking, how do you make an investment decision? How good do the prospects for an investment decision have to be in order to justify investment if it's irreversible and long life? Okay? And you can think of that as a one-shot decision. When do I exercise my call? But wait a minute. The risk you have, suppose the risk you have is that some competitor is going to come in, perhaps with a new technology, and take away your business. That limits your upside. But now think of that. Now you have to ask, at what price will the competitor come in? Let's say at date one, if the competitors are interested in coming in date one. You've done it date zero. Date one, competitor comes in and thinks. That competitor is going to have to think about what happens at day two. Because if the second one comes in, that in turn is at risk for a third in some later date. And whoever comes in at the third date has to worry about what happens at date 4 and so on. So I and then Jerry developed a kind of real options model which not only calculates the optimal time to exercise a single call option, but calculates the optimal decision about the single call option if, or taking into account the fact that there could be later competition all along the future life of the asset. So it's more than the standard real options application, which typically looks at a one-off thing. Now, this was quite a plateful for the Surface Transportation Board, I must admit. So, I did 3 or 4 pieces of testimony working out what what level of profits is sufficient to justify entry in a situation like this where there's exposure to competition all the way out for the life of the asset. Now, of course, I'm thinking of competition, but you could think of the regulators as doing the same thing, cutting off the upside as you will. But this is one example of something that was pretty technical, and no matter how well you explained it, it was an uphill battle. But I think we were right. Jerry and I wrote this up in a paper that I think is correct. I think the paper is correct. Whether the Surface Transportation Board would ever use that, probably not. But I think we were right. And you know, it may have some. I'm looking at Bob Pindyke, who wrote a book on real options with Nash Dixit. I think the point that exercise of a call is not a one-time thing but has to worry about future exercise against you is important. So that was a lot of fun. But in the end, we or I didn't get all that far with the regulators.
That happens a lot.
Partly because the rest of the regulatory apparatus of the Surface Transportation Board was just incredibly complicated. Yeah, go ahead, sorry.
So we talked a lot about the work that you've done over the years. A couple of weeks ago, Bart Lambrecht sent one of your latest papers with him, which is a very interesting one, which turns the agency problem around from the way that we usually think about it, or the way that you started us thinking about it. So instead of the shareholders being the principal and the manager being the agent, the manager is the principal, subject to a governance constraint. And this is one little paper which I recommend to all of you, where they start to put together all the corporate finance decision that firms make. So typically we look at them one at a time. And this paper starts looking at them and trying to understand the interrelationship between them and how they interact. And I thought it'd be very interesting if you explained a little bit about that and where you think that's going in the future.
Okay. You know, we were talking about big ideas in finance, and the one you didn't mention was agency. The idea that you got to understand that managers are agents of the stockholders, or at least the law custom thinks of it that way. And because they're agents and they're self-interested, they're not going to necessarily do the right thing. So I want to say a word about the history of that, because the point about agency as being a fundamental economic problem, right. The literature on optimal contracting, optimal compensation schemes, the theory of principal-agent relationships is fascinating and very well developed. The next question is, how do you apply it to corporate finance? And in particular, how does it apply to big public corporations, which is what we usually start with in corporate finance? How does it apply to an IBM or an Energy or a Deutsche Bank, any large public corporation? And here, I guess I'm going to be too blunt, but I'm going to say this in a more. It's going to sound maybe a little bit aggressive, and I'm only doing it for emphasis and to simplify. How do you apply agency theory to a big corporation? Well, I think in the literature you're going to see two common answers. One is to assume that if you just get the CEO is the agent, and if you just get that CEO's incentives right, everything will be fine. And I think that's stupid. And the reason it's stupid is it assumes that the CEO is like a puppet master who can control everything decision that the company is making, and that could put the firm on a 90-degree left turn, or 90-degree right turn on whatever the topic is at the CEO's personal whim or judgment. Now that's dumb. They're big organizations, and at the very least, the CEO has to keep everybody else in the organization motivated. Right? So I accept that idea of modeling CEO compensation is a valuable thing to do. I accept that if you're talking about smaller and entrepreneurial firms, that may be exactly the way to look at it. But big corporations, I don't think so. The other idea that has been popular is the so-called free cash flow hypothesis that goes back to Mike Jensen in, 78. The first wave of mergers that I would call diet deals. And Look back at that time and think of the attempts to take over Phillips Petroleum, or what were the others? Phillips, particularly the oil companies at that point were natural targets because they had been used to a period of high oil prices. They had a lot of pressure to explore and replace their reserves, and they were basically wasting money. So Boone Pickens and others figured out that you could make a profit simply by taking over these companies and stopping them from investing. And that led to this idea of free cash flow, which says that managers, if given the cash, will always invest it, and probably wastefully. Now, there are good examples of that happening. RJR Nabisco would be an obvious one. But I don't think that's a widespread problem, at least with today's governance. And there is no free cash flow theory of corporate finance. Because if you really zero in on people who say they have a free cash flow theory of corporate finance, it usually comes out saying there's some good managers who waste money and some bad managers who don't. And then it goes on to say one way to discipline the bad managers is to load up on their debt so that they have to pay out cash, but never explain why they can't replace the cash by issuing equity. Never explain that. So it just doesn't hold together. I think that now the question is what next for big corporations? I think the focus should change from agency to governance, which is a different thing. It says that, yes, people run corporations are self-interested, and there's a governance system, which varies country by country, maybe even company by company, which keeps them in control. So governance goes through boards of directors, SEC regulations, security analysts watching, bankers and lenders watching. So I think it's better to think of the managers acting as self-interested agents, but subject to a governance constraint. So you let the managers make the decisions, rather than asking whether there's an explicit or implicit contract between the managers and the stockholders that will force them to make the right decisions. Just say they got a constraint. And so that's what Bart and I have been working on, and I think we made some progress. Can I brag about one thing we found?
Yes, please
So,
do.
Pardon me?
I said if there's any occasion to do so.
This is probably my last chance, right?
It's renewable.
Okay.
Think of your sick leave.
So if you think about dividend payout policy, the empirical model of dividend payout policy goes back to John Linden in 1956. His target adjustment model has been used in all the empirical tests of payout policy, and up to date, I think. And it had never been derived from any kind of model from fundamental assumptions. Never been derived. Okay? It has prediction that companies will stabilize dividends and smooth them. Okay. But if you look at suppose you look at how people explain why companies smooth dividends. The argument usually goes something like this. Managers smooth dividends because they're worried that if they don't, stockholders will be upset. And stockholders come to accept that managers will smooth dividends, and therefore they do get upset if they don't. You see the circle? So anyway, Bart and I have this paper in 2012 that just starts out with a model of agents who are taking rents out of the firm, which is okay in my opinion, or can be okay in my opinion. And it's subject to government constraint, and then the insight is that if the government constraint is binding, then the rents they take out of the firm have to be matched in some proportion by the money they pay out to shareholders. So we derived the Lindner formula not because stockholders want it, but because the managers wanted to smooth their rents, wanted to smooth their own compensation over time. And in that case, the Lindner formula is not anything to do with stockholders, but management behavior. I thought that was sort of cool.
That is cool.
I'm going to say one more thing. Can I go back to the free cash flow theory, which I've been unfair too, I think. People who do that typically have a model in mind in which the government constraint is not binding. So if you have a constraint that's not binding, it can't have any effect, and it leaves the managers with the freedom to do what they want. Okay? But if the managers are optimizing, they won't leave that constraint slack. They will pursue their own interest up to the point where it is binding. And if it is binding, then there's no point in saying there's a free cash flow theory. And in fact, companies don't, the theory says companies don't overinvest, they underinvest because of manager risk aversion. Can I mention one more pet peeve? The other pet peeve is theories which, theories of agency or corporate finance, which start with the assumption that the CEO controls things. That's mistake number one, at least for large corporations. And number two assumes that the manager gets some sort of psychological benefit out of investing and therefore will always do so unless constrained. That may be true, but normally in finance we don't resort in the first instance to purely financial motives, purely psychological motives to build our models. We like to build our models first with things that you can actually see and touch and measure. And only if those models fail do we have to pull in some behavioralism. But there's an awful lot of elegant models out there that start with that. So that's a pet peeve. So you've got me, you got me on the pet peeve. Anyway.
I'm looking forward to seeing much more of that. It's a very interesting approach.
Oh, can I mention one more thing? that took me 45 years to get, okay? So think of a mature corporation which has, I would say, a mature corporation which can pay out money to investors on a regular basis. And it's not going to go default. Default is remote. Such a company has three big decisions. It's got to decide how much to invest, how much to borrow, and how much to pay out. Okay? How many independent theories of those three decisions can there be? Only two. Right? Because if you have a theory that covers two, you automatically determine the third. And so that's another thing that Bart and I are trying to nail down. If you look at some of the, suppose you go back and look at the simple theories of trade-off theory, let's say, of capital structure. That imagines a company holding assets constant and then moving the debt ratio back and forth by debt equity substitutions, or equity debt substitutions until you get to the right ratio. Well, if you hold capital investment constant, that movement of debt to equity or vice versa has to be picked up by payout. There's no other place for the money to come or go from. So if you really believe that the capital investment is exogenous and that the companies are trying to get to a target capital structure, actually moving back actively towards it, then you must also believe that payout policy is a shock absorber. And yet we have independent evidence that payout is smooth.
I see Annette.
I wanted to kind of, I don't want to interrupt a really interesting discussion,
You've already done
but I
so.
wanted to give the audience the chance to also ask a few questions, given that people haven't texted us questions. I was thinking maybe we were being too MIT-ish, so I wanted to kind of ask if anyone actually has, in the audience, given that there's so many friends of Stu here, whether you have questions and I have a mic and we can maybe even do it without mic. Would that be okay? Maybe
I can go with the answers now.
Can I ask them, can I ask the first question? Because I thought it was very provocative what you said at the beginning about the fact that Modigliani Miller is basically right and that all financing structures are tactical. How do you, I mean, in that respect, how do you think about the fact that investment banking markets and a whole very big industry is structured around those, according to you, very tactical questions? Is that really, it could be a very populist view, right, of saying these are very small margins that very high-paid people are fighting over, or do you see actually that there is a very different value proposition besides getting capital structure right?
Okay, I was obviously simplifying to make a point, but I think if you think tactically, you've got to think of value being fixed, independent capital structure up to, you pick your band, whether it's plus or minus 2% or plus or minus 3, whatever it is, but a relatively narrow band. Now, it depends, with investment banking, it depends what you're thinking about. If you're simply thinking about should the company issue debt or equity this time, or should it do a debt equity swap, let's say, or more realistically, over the next 2 or 3 years, buying back fewer shares, borrowing the money to buy back shares, or buying back fewer shares and paying down your debt. If it's that kind of debt equity adjustment, I think that's within the error band. And think of the commissions that investment bankers charge and so on. Sure, they might get good living out of it, but it's not a big fraction of the value of the firm. I admit the case where investment bankers seem to take a big chunk out of transactions is in M&A. And not always sure how they do it, but they manage. And I would accept that in M&A deals, particularly hostile ones, the fees and costs of doing it are outside my band. I'd agree with that.
Can I just ask one more while Anna's doing that? Oh, sorry,
You can maybe.
sorry, no, off you go. Sorry, I'm sorry.
Stu, as you think about your career and all the different papers you've written, there must have been a few surprises for you, just in the sense that, what was the most satisfying impact that you had with one of your papers, or was it the book, or and were there any surprises where you really thought that something got more usage than you expected it to, or something that you really thought was great did not get used so much? So it's just kind of reflections on your career in publishing and the market's reaction and usage of that. Any comment?
Well, if you take the Brealey-Myers Allen book, I do think that had an impact on practice.
I would think that
And
that'd have to be pretty much
very
first.
gratifying.
Sure.
That was gratifying. And we'll set aside the regulatory stuff for the moment for this question. If I had one big disappointment, which I hope will be reversed, it's the work that Jamie Initial and I have done recently on capital allocation, or risk capital allocation for banks, which seems to us absolutely straightforward and simple, and much simpler than RAROC and these various kinds of ad hoc measures of the risk of particular assets or positions the bank will take. It turns out that the principle is very simple. You allocate capital based on the marginal effect of a particular asset or position on the company's default foot. So you basically look at a bank or a financial institution as a bundle of assets and liabilities, and you pick one asset and ask, if we expand that asset for $1, what's the derivative of that on the value of the default foot? And it turns out that if you allocate capital based on those derivatives, everything adds up exactly, that makes sense. And yet in real life, we have, what is it, RAROC, and I'm a senior moment now. What's the word for the measure that looks at how many standard deviations? VAR, V-A-R. Those things don't make sense. And so here we got this paper, and you'd think the companies would be snapping it up. Total silence. And what that says is that it's our responsibility to write it up and publicize it in a way that's more accessible. That in a way is the is the one that comes to mind currently.
Seems like your pecking order theory really got a lot of usage and not a big play. Did that surprise you?
Actually, no, because I thought that was a really cool idea. And it was different enough that it attracted attention.
Only knew someone who wrote a textbook, you could get it put in the textbook.
Sorry, so you say that for the audience?
I said, if only he knew someone who wrote a textbook, maybe he could put this idea in that textbook.
Right.
Stu,
Yeah.
I have a question, but I'm not sure it falls in your definition of a finance question. From time to time, corporations misbehave. 2008, it was thought that a number of corporations misbehaved, and various efforts were made to discipline them for that infraction. And we all celebrate when we read that the government has extracted multiple billions of dollars from a bank or something it did. And if you trace where that money comes from, it comes from the widows and orphans who own the equity.
Yeah.
Do you have any ideas as to a more effective way to lead people from a path of iniquity? You can say no.
I guess the answer is no, but I do bridle sometimes at complaints that you see by editorialists as saying that, why aren't all these executives who made the stupid decisions in jail? And if you say it that way, you're basically saying stupidity is a jailable offense, right? And unfortunately, stupidity is going to happen. It happens for reasons that are hard. When it happens not because some single individual decided to be a bad person, although there certainly are bad people out there. It happened because they get swept up in something that is partly caused by government, partly caused by macroeconomic or economic changes, partly caused maybe even by inefficient markets. And they get swept up in it, and then you get some horrible event.
Right. But punishment, the kind of punishment we invoke, don't deal with those things, and therefore fall on people who are essentially innocent.
That's true. They fall into corporations.
Yeah.
And the government right now is finishing up an extortion game to get as much money out of the major banks as they can. And it comes from shareholders.
Doesn't seem to me to be a good system.
But you see, I just don't know what to say. I will give you a prediction confidently that we will never have another crisis caused by mortgage-backed securities and real estate. Never. Just as we only had one savings and loan crisis. But the next crisis is going to be different. There's going to be something that where human beings and corporations got to.
We invoke now may not have any effect on that possibility.
Probably right. Probably right. I didn't give you a very good answer to that. Sorry.
You read my answer.
There are no more questions in the room. Then I would like to thank all the panelists in Stu, of course, and all of you for a very
Okay, you guys.
Great, thank you. Thanks, everybody. Thank you.